All right, let's talk about one of the most powerful and maybe one of the most misunderstood tools in all of business, the cash budget. And seriously, forget about boring spreadsheets for a second. I want you to think of this as your company's financial crystal ball. It's something that can literally help you predict the future and can mean the difference between thriving and completely failing.
So to get why this is so critical, let me kick things off with a question that kind of sounds like a riddle. Is it actually possible for a company that's profitable, one that's making money on paper, to go completely, totally bankrupt? The answer is a huge, surprising, emphatic yes. And you'd be shocked how often it happens. It all comes down to one of the most important rules in business. Profit is an opinion, but cash is a fact. See, profit lives in your accounting books, but cash is what you use to pay your employees, to settle your bills, to keep the lights on. The moment that cash runs out, it is game over, no matter what your profit and loss statement says.
Okay, so how do you possibly avoid that nightmare scenario? How can you see those financial storm clouds gathering on the horizon before they actually hit? Well, that's where that financial crystal ball we just talked about comes in. You see, an income statement, that tells you where you've been. A cash budget, on the other hand, is a forecast. It's a roadmap that tells you where you're going. It's a super detailed plan of every single dollar you expect to come in and every dollar you expect to go out over the next month or the next quarter or even the next year. It is the guide to your single most vital resource.
And the real power of the cash budget comes from its beautiful simplicity. I mean, everything, and I mean everything, boils down to this one simple formula. You just take the cash you're starting with, you add all the cash you expect to come in, you subtract all the cash you expect to go out, and that gives you your ending cash. That simple little equation is the foundation for everything we're about to do.
So what's the real payoff? Why go through all this trouble? Well, first, it lets you see a cash crunch coming months in advance, which gives you time to react before it becomes a crisis. Second, it also shows you when you'll have extra cash, so you can make a plan to invest it instead of just letting it sit there doing nothing. And here's a little pro tip for you. Bankers absolutely love this stuff. If you walk into a meeting with a detailed cash budget, getting a loan becomes so much easier and cheaper. Ultimately, this thing is the master document. It ties all your other plans, sales, production, everything into one single financial truth.
So, to build this thing, we basically need to track two things: money coming in and money going out. Let's start with the fun part, forecasting all the cash that's coming into the business. Now, obviously, your main source of cash is your customers. But here's the crucial detail that a lot of people miss. It's not about what you sell, it's about when you get paid. Your sales report might show $1 million in sales, but the cash budget only cares about one thing: how much of that cold hard cash actually landed in your bank account this month. That includes payments for this month's sales, sure, but also collecting on past sales, your accounts receivable, plus any other cash you might get from things like investments or loans. Now for the other side of the coin, forecasting the cash that's going out. And this requires the exact same discipline. It's not about when you get a bill in the mail, it's about when you actually write the check and send the money out the door. Again, it's all about timing. Your operations plan might show that you used a bunch of raw materials this month, but the cash budget doesn't care about that. It only tracks when you actually paid the supplier for them. And the same rule applies to every other outflow: paying your employees, covering overhead, sales expenses. It also includes those bigger, less frequent payments like buying a new piece of equipment or making a loan payment. Every single dollar leaving your account has to be accounted for.
So, we have our two key ingredients, right? The cash we expect to come in and the cash we plan to send out. Now let's put them together and actually see how this whole budget takes shape.
The process itself is just 4 really logical steps that follow that formula we talked about perfectly. Step 1, you figure out your starting cash balance. How much do you have right now? Step 2, you add up all your expected cash receipts. Step 3, you subtract all your planned cash payments. And that brings you right to Step 4, calculating your final ending cash balance. That's it. It's really that straightforward. Okay, let's see this in action. Look at January. We start with $10,000 in the bank. We follow the column down, we add $50,000 in receipts, then we subtract $55,000 in payments, and that leaves us with an ending balance of $5,000. Now here is the most important part, so watch this. See that ending $5,000? It rolls over and becomes the beginning balance for February. That's the link. That's what connects the months and turns this from a list of numbers into a financial story. And this story is telling us that January is going to be tight, but it's followed by a recovery in February and March. Seeing that coming, that's what makes this tool an absolute game changer.
So I'll just leave you with this one thought. A lot of businesses have a financial plan. They have a business plan, a sales plan, a marketing plan, all designed to create profit. But as we've seen, profit isn't cash. So the real question you have to ask is, do you have a cash plan? Because at the end of the day, that's the plan that truly determines survival.